Alright folks, welcome to the channel. I'm King, and today we're not just talking about money, we're talking about your future, your legacy, and how to get there with a smart, deliberate plan. We're diving deep into something absolutely critical for anyone serious about building wealth. Your investment objectives. Think of it like this. You wouldn't build a castle without a blueprint, would you? Of course not. You'd end up with a lopsided shack, not a fortress. Investing without clear objectives is pretty much the same deal. You're just throwing your hard-earned money out there and hoping for the best. And hope is not a financial plan, people. It's actually the final countdown, du-du-duuu-dun, last level left. This isn't just another video, this is about getting you to that final level of financial understanding, where you're in control, making informed decisions, and marching confidently towards your goals. Aligning your goals and objectives to your investing strategy is often overlooked, but it's a necessary step when you are investing. Too many people skip this part, thinking it's too complicated or not important. Let me tell you, that's a recipe for disappointment, and we're not about disappointment here. We're about winning. So, if you're tired of feeling lost in the financial wilderness, if you're ready to take command of your investment strategy, and if you want to build a financial future that's strong and secure, then you are in the right place. We're going to break this down, step by step, question by question, so you can walk away from this with clarity and a renewed sense of purpose for your money. Grab a notepad, turn off the distractions because class is in session, and your financial future depends on it. Let's get to it. Alright, let's get down to brass tacks. The big question, how do I set my investment objectives? It sounds like a mountain to climb, but I'm here to tell you it's more like a series of well-placed stepping stones. The core idea, folks, is to ask yourself the right questions. Not just any questions, but the kind that cut through the fog and give you real, actionable clarity. You see, your investment objectives are the why behind your what. Why are you investing this money in the first place? What do you want it to do for you? Without knowing the destination, any road will get you there, which usually means nowhere good. Think of it like planning a major journey. You wouldn't just hop in the car and start driving, would you? No. You'd figure out where you're going, why you're going there, how long it'll take, and what you need for the trip. Setting investment objectives is exactly that process, but for your money. It's about defining what success looks like not for your neighbor, not for some guru on the internet, but for you and your family. This isn't about chasing hot stocks or jumping on the latest fad. It's about building a solid foundation. The clarity you gain from asking these questions is paramount. It's what transforms you from a passive bystander in your financial life to an active, engaged commander. These questions will force you to confront your current financial reality, your future aspirations, and the path that connects the two. It's about getting intentional. So many people wander through their financial lives reacting to things instead of proactively planning. We're going to change that for you, starting right now, by showing you what those key questions are. So, what are these magical questions? Well, they revolve around your goals, your timeline, your comfort level with risk, the resources you have, and how you'll need the money down the road. Each question builds on the last, creating a comprehensive picture of your personal investment landscape. Don't rush this process. Give yourself time to think deeply and honestly. The answers you come up with will form the bedrock of your entire investment strategy, guiding every decision you make from here on out. Remember, the goal here isn't to become a Wall Street wizard overnight. The goal is to become a wise steward of the resources you have. It's about making your money work for you, not the other way around. By asking the right set of questions, you're essentially drawing a map, your personal treasure map, leading to financial peace and the achievement of your most important life goals. So, let's get ready to explore those specific questions in the chapters to come. First things first, folks, when we talk about setting investment objectives, the absolute cornerstone is figuring out what is your goal, and I mean specific goal, not some vague idea of getting rich, because that's not a goal, that's a wish. A goal is something tangible, something you can define, something you can aim for with precision. Without a clear target, you're just shooting arrows into the dark, and that's no way to manage your hard-earned money. You need to sit down and really think about what you want your investments to accomplish. Let's consider some common, concrete goals people have. Maybe you're dreaming of buying a house, a place to call your own, to raise your family, to build memories. That's a fantastic goal, but it requires a specific amount of money by a specific time. Or, perhaps your focus is on your children's future. You want to build a corpus for their education, ensuring they have the best opportunities without being saddled with crippling student loan debt. That's a noble goal, and a very common one for parents who want to give their kids a head start in life. Another major goal, and one that becomes increasingly important as we get older, is planning for retirement. You want to ensure you have enough money to live comfortably when you're no longer working, to enjoy your golden years without financial stress. This isn't just about not working, it's about having the freedom to travel, pursue hobbies, or simply live with peace of mind. Or maybe your goal is more immediate, like reducing your current tax burden through smart, tax-advantaged investments. That's a legitimate financial objective that can free up more of your income. Then there are folks who are looking to generate regular monthly income from their investments. Perhaps they're already retired, or they're looking for a supplementary income stream to improve their cash flow. This requires a different investment approach than, say, long-term growth for a house down payment 10 years from now. Each of these goals, buying a house, funding education, securing retirement, reducing taxes, or generating income, dictates a different strategy, a different timeline, and a different risk tolerance. So, I want you to pause and really think about this. What are working towards? Write it down. Be specific. Is it one big goal or several smaller ones? Knowing this why is the most powerful motivator and the most critical piece of information you need before you even think about where to put your money. This isn't just financial planning, it's life planning. Get this right and everything else starts to fall into place. Don't skip this step, it's foundational. Alright, so you've nailed down your why, your financial goals. Fantastic! The next crucial question you need to answer is, what is the time period for making investments? This is often called your investment horizon, and folks, it's a game changer. The amount of time you have before you need to access your money will dramatically influence the types of investments that are suitable for you. It's like asking how long you have to cook a meal. A 5-minute dish is very different from a slow-cooked stew. Your age plays a significant role here, no doubt about it. If you're in your 20s or 30s, saving for retirement, you've got decades ahead of you. This longer time horizon generally allows you to take on more risk, because you have more time to recover from any market downturns. Time is your greatest ally in investing, thanks to the power of compound growth. The longer your money is invested, the more opportunity it has to grow exponentially. It's a beautiful thing when you let it work for you. However, it's not just about your current age, it's about when you need the funds for those specific goals you've set. For instance, if your goal is to save for a down payment on a house in 3 years, your time horizon is short. In this scenario, you can't afford to put that money into something highly volatile, because a market dip right before you need the cash could derail your plans completely. For short-term goals, capital preservation becomes much more important than aggressive growth. Conversely, if you're saving for your newborn's college education, you might have an 18-year time horizon. That's a long runway, which again, allows for a potentially more growth-oriented strategy. The key is to match your investment timeline to your goal's timeline. Don't make the mistake of investing money you'll need in 2 years into a long-term, high-risk venture. That's just asking for trouble, and we're about avoiding trouble and building wealth intelligently. So take each goal you've identified and assign a time frame to it. How many years, or even months, do you have until you need to access those funds? Be realistic. This will help you categorize your goals into short-term, less than 3 to 5 years, medium-term, 5 to 10 years, and long-term, 10+ years. This simple act of assigning a time period will provide immense clarity and guide your subsequent decisions about where and how to invest. It's a critical piece of your personal investment puzzle. Now we're getting into the real nitty-gritty, folks. After you've defined your goals and your time horizon, you absolutely must ask yourself, what is your risk-taking capacity? This is about understanding your personal comfort level with the possibility of losing money even temporarily. Investing always involves some degree of risk. Anyone who tells you otherwise is selling snake oil. The key is to find the right level of risk, one that lets you sleep at night. First, let's distinguish between risk tolerance and risk capacity. Risk tolerance is your emotional ability to handle market fluctuations. Do you get queasy when your account balance drops? Or can you stomach the ups and downs knowing it's part of the long-term game? Then there's risk capacity, which is your financial ability to withstand losses. Do you have a stable income, a solid emergency fund? If you experienced a significant investment loss, would it jeopardize your essential living expenses or your long-term financial security? These are two different things, and both are important. To determine your risk appetite, you need to be brutally honest with yourself. How much money could you afford to lose, in a worst-case scenario, without panicking and making rash decisions like selling everything at the bottom of the market? That's often when the biggest mistakes are made. If the thought of your investments dropping 10% or 20% in a short period keeps you awake, then a high-risk, high-reward strategy probably isn't your cup of tea, no matter what your financial advisor might suggest based purely on your age. Your financial ability to suffer short-term losses is critical here. If you have a fully funded emergency fund covering 3 to 6 months of expenses, and no high-interest debt like credit cards, you're in a much better position to absorb some market volatility with your long-term investments. But if you're living paycheck to paycheck, or have a mountain of debt, then taking on significant investment risk is like playing with fire. You need to get your financial house in order first. That's foundational. Understanding your risk profile isn't about being a daredevil or a scaredy cat. It's about aligning your investments with your financial reality and your emotional makeup. There are questionnaires and tools that can help you assess this, but ultimately, it comes down to self-reflection. Knowing how much you can lose and not panic will guide you towards investment choices that you can stick with through thick and thin. And consistency, folks, is a major key to long-term investing success. Don't chase returns you can't stomach the risk for. Alright, team, let's talk about the how much and how often part of your investment plan. The next big question to ponder is a lump sum amount available for you to invest? Or are we talking about investing excess income on a regular basis? Or perhaps it's a combination of both. The answer to this will significantly shape your investment approach and the mechanics of how you put your money to work. It's about understanding your current cash flow and available capital. Many people come into some money through various means. Maybe it's a bonus from work, an inheritance, or proceeds from selling an asset like an old car, or even a previous investment. This is what we call a lump sum. If you have a significant chunk of cash ready to go, you have the option to invest it all at once. This can be a powerful way to get a substantial amount of money into the market quickly, potentially benefiting from immediate growth if market conditions are favorable. However, not everyone has a large sum sitting around, and that's perfectly normal, folks. For most people, investing happens through regular contributions from their monthly income. This is what we call systematic investing, often done through something like a systematic investment plan or SIP. You decide on a fixed amount you can comfortably set aside each month or each quarter, and that money is automatically invested. This approach is fantastic for building discipline and making investing a habit. The beauty of systematic investing, especially when you're investing a portion of your excess income, is a principle called dollar cost averaging. When you invest a fixed amount regularly, you buy more units when prices are low and fewer units when prices are high. Over time, this can average out your purchase price and reduce the risk of investing a large sum at the wrong time, like right before a market dip. It takes the guesswork and emotion out of trying to time the market, which, let me tell you, is a fool's errand. So, assess your situation. Do you have a windfall you're looking to invest? Or are you planning to build your wealth steadily by investing a part of your salary each month? Maybe you have a lump sum now and also plan to invest regularly. Knowing this determines whether you'll be making a one-time significant investment, setting up recurring investments, or a mix. This isn't about which one is universally better, it's about what fits your current financial reality and helps you consistently move towards your goals. We've talked about putting money in, but now let's consider the other end of the journey, taking money out. A crucial question for your investment objectives is, do you need the money in one single installment, or will you require it in tranches, meaning in several smaller portions over time? This might seem like a distant concern when you're just starting, but planning your exit strategy, or how you'll access the funds, is just as important as planning how you'll grow them. Think about your goals again. If you're saving for a down payment on a house, you'll likely need that entire sum as one lump payment when you close the deal. There's no point in getting half the down payment now and half later. The seller won't accept that. So for a goal like this, your investment plan needs to be geared towards having the full amount available at a specific point in time, and you'll likely liquidate those investments all at once. However, consider retirement. Most people don't need their entire retirement nest egg on day one of retiring. Instead, they need a steady stream of income to cover their living expenses over many years, perhaps even decades. In this scenario, you might plan to sell your investments in a phased manner, withdrawing a certain amount each month or year. This allows the remaining portion of your investments to continue growing, potentially for a very long time. This is a common strategy for creating retirement income. Another option, particularly for retirement income, is an annuity. This is where you might use a portion of your investment corpus to purchase a financial product that guarantees you a regular payment for a set period or for the rest of your life. While annuities have their own set of pros and cons that need careful consideration, they represent another way to receive your money in tranches rather than all at once. It's about matching the withdrawal plan to the nature and duration of the need. So, for each of your investment goals, think about the withdrawal phase. Will it be a one-time need, like for that house or maybe a child's wedding? Or will it be an ongoing need, like monthly income during retirement or funding college tuition over several semesters? Understanding this will influence how you structure your portfolio as you get closer to your goal, perhaps shifting to less volatile assets to protect the capital you're about to withdraw. Planning the harvest is as vital as planting the seeds. Alright, this is a question I get all the time, folks. King, should I be putting my money into mutual funds, or should I be picking individual stocks? It's a great question. And the answer, like many things in personal finance, depends on your knowledge, your available time, and your stomach for risk. There's no single right answer for everyone, but let's break down the considerations so you can make an informed choice for your kingdom. First up, let's talk about diversification. You've heard me say it before, and I'll say it again. Don't put all your eggs in one basket. That's just plain dumb. Mutual funds, by their very nature, offer instant diversification. When you buy into a mutual fund, you're buying a small piece of many different companies, sometimes hundreds of them, all bundled together. This spreads your risk. If one company in the fund doesn't do well, it's cushioned by the performance of the others. For most people, this is a much safer and simpler way to get started in the market. Now, investing in individual stocks. This is where you, the investor, pick specific companies you believe will perform well. If you pick a winner, the returns can be fantastic, much higher than what you might get from a diversified mutual fund. However, the flip side is also true. If you pick a loser, or if a company you've invested heavily in goes belly up, you can lose a significant amount of money, even all of it for that particular stock. It's a higher risk, potentially higher reward game. The big factor here is the time and knowledge required. Successfully picking individual stocks isn't about throwing darts at a list of company names. It requires serious research. You need to understand financial statements, analyze company performance, study industry trends, assess management quality, and keep up with market news. This is practically a full-time job if you want to do it well. If you don't have that kind of time or expertise, or frankly the interest, then trying to be a stock-picking wizard is probably not for you. So, what's the King's Counsel here? For the vast majority of people, especially those just starting out or those who want a more hands-off approach, mutual funds are an excellent way to build wealth over the long term. They offer diversification and professional management. If, and only if, you have a deep understanding of the stock market, you enjoy the research, you understand the risks involved, and you have money you can afford to lose, because picking stocks is speculative, then you consider dedicating a portion of your portfolio to individual stocks. But for most, mutual funds are the smarter, more reliable path. Okay, so let's say you're leaning towards mutual funds, which for most folks is a smart move. The next layer to this onion is deciding between actively managed funds and index funds. This is another one of those choices that can seem confusing, but I'm here to shine a light on it for you. Both have their place, but understanding the difference is key to aligning your investments with your overall philosophy and goals. First, let's talk about actively managed funds. As the name suggests, these funds have a fund manager or a team of managers actively making decisions about what stocks or bonds to buy and sell. Their goal is to outperform a specific market benchmark, like the S&P 500 or a particular bond index. They use research, analysis, and their expertise to try and pick winners and avoid losers. Because of this active management and research, these funds typically come with higher expense ratios. That's the fee you pay for them to manage your money. Now, let's look at index funds. An index fund is a type of mutual fund, or ETF, which is similar, with a portfolio constructed to match or track the components of a financial market index such as the S&P 500. So if you invest in an S&P 500 index fund, you're essentially buying a tiny piece of all 500 companies in that index in the same proportion as the index itself. There's no genius fund manager trying to beat the market. The goal is simply to the market, to mirror its performance. Because there's less active management, index funds typically have much lower expense ratios. Here's the kicker, folks, and study after study has shown this. Over the long term, the vast majority of actively managed funds fail to consistently outperform their benchmark index, especially after you factor in their higher fees. Think about that. You're paying more for active management, but statistically, you're often getting less in return compared to a simple low-cost index fund. Now, some active managers do outperform, but picking them in advance is incredibly difficult, like finding a needle in a haystack. So what's my recommendation? For most investors, especially if you're just starting out, or if you prefer a simple, low-maintenance and cost-effective approach, index funds are a fantastic starting point. They give you broad market exposure at a very low cost. You're essentially betting on the overall growth of the economy, which, historically, has been a pretty good bet. You can certainly evaluate other alternatives, including some well-chosen, actively managed funds if you do your homework, once you've got your feet wet and understand the landscape better. But don't underestimate the power of simplicity and low costs. We're getting really specific now, which is great. You're building a solid understanding. Once you're looking at mutual funds, you'll encounter different categories based on what they invest in. The main types you'll hear about are debt funds, equity funds, and hybrid funds. Choosing the right mix of these is all about balancing risk and reward, and aligning it with your goals, time horizon, and that risk appetite we talked about earlier. It's about creating a diversified portfolio that's tailored to. Let's start with equity funds. These funds primarily invest in stocks or equities of companies. They aim for capital appreciation, meaning they want the value of your investment to grow over time. Equity funds have the potential for higher returns, especially over the long term, because historically stocks have outperformed other asset classes. However, they also come with higher risk. Stock markets can be volatile, meaning their values can go up and down significantly, especially in the short term. If you have a long time horizon and a good tolerance for risk, equity funds will likely form a significant part of your portfolio. Next up are debt funds. These funds invest in fixed income securities like government bonds, corporate bonds, and other debt instruments. Think of it like this. When you invest in a debt fund, you're essentially lending money, and in return, you expect to receive regular interest payments and the principal back at maturity. Debt funds are generally considered less risky than equity funds. Their primary goal is often capital preservation and generating a somewhat stable income. If you have a shorter time horizon or a lower risk tolerance, debt funds will play a more prominent role in your asset allocation. Then, we have hybrid funds. As the name suggests, these funds are a mix. They invest in both equities, stocks, and debt instruments. The proportion of equity to debt can vary widely, depending on the specific fund's objective. Some hybrid funds are more aggressive, with a higher allocation to equities, while others are more conservative, leaning more towards debt. Hybrid funds aim to provide a balance of growth, from equities, and stability, from debt, potentially offering a smoother ride than pure equity funds. They can be a good option for investors who want some equity exposure, but with a bit less volatility. The key here, folks, is creating a diversified portfolio that is best suited to your unique risk appetite and investment time horizon. There's no one-size-fits-all answer. Younger investors with a long time until retirement might have a portfolio heavily weighted towards equity funds. Someone nearing retirement might have a much larger allocation to debt funds and conservative hybrid funds to protect their capital. Don't hesitate to seek investment advice from a qualified, trustworthy financial advisor if you're unsure how to strike the right balance. Their job is to help you build a portfolio that fits needs, not theirs. You bet I can. That's exactly what we've been doing throughout this entire discussion, and what I aim to do here at this channel. The question, can you guide me through the process, is the natural next step. You've absorbed a lot of information, and now it's about putting it all together systematically. My goal as king is to empower you, my people, with the knowledge and the steps to take control of your financial destiny. So yes, let's solidify that guidance. We've walked through a series of critical questions, haven't we? Each one was designed to help you build your investment objectives from the ground up. We started with the absolute foundation. What is your goal? Defining that clear target you're aiming for. Then we moved to, what is the time period for making investments? Understanding your investment horizon for each of those goals. This helps you match the strategy to the timeline, which is just common sense but so often ignored. Next, we tackled the very personal question of what is your risk-taking capacity. This is about knowing yourself, your financial stability, and your emotional fortitude when it comes to market swings. Then we looked at the practicalities. Is a lump sum amount available, or excess income investable? This determines how you'll actually get your money into the market, all at once, or bit by bit. And we didn't forget the end game. Do you need the money in one installment or again in tranches? Planning how you'll access your wealth. Then we dove into the what to invest in questions. Should I invest in mutual funds or individual stocks? Highlighting the importance of diversification and the realities of stock picking. We followed that with, should I invest in actively managed funds or index funds? Discussing the impact of fees and the strong case for low-cost index investing for many. And finally, should I invest in debt funds, equity funds, or hybrid funds? Which is all about asset allocation to match your risk profile and goals. So the guidance is embedded in these very questions. Your task now is to go back through each one, thoughtfully and honestly answer them for yourself, and write those answers down. This becomes your personal investment policy statement, your blueprint. It's not a one-time exercise. You should revisit it periodically, especially if your life circumstances change. But by following this process, you're no longer investing blindly. You're investing with purpose, with clarity, and with a plan. And that, folks, is how you win with money. All right, folks, we've covered a tremendous amount of ground today, and I truly believe that if you take these principles to heart, if you answer these questions honestly, you'll be well on your way to mastering your investment objectives. This isn't just about numbers on a screen. This is about building the life you want, securing your family's future, and achieving that financial peace we all crave. It's actually the final countdown. Du-du-duuu-dun. Last level left, and you now have the map to conquer it. Remember, aligning your goals and objectives to your investing strategy is the cornerstone of successful wealth building. Don't let this just be another video you watched. Take action. Sit down this week, carve out some quiet time, and work through these questions. Write down your goals, your timelines, your risk tolerance. This is your financial kingdom we're talking about, and you are the ruler. You have the power to make informed decisions. The journey of 1,000 miles begins with a single step, and today, you've taken a giant leap in understanding. Keep learning, keep growing, and keep building. Now, before we wrap up, a few important notes. Disclaimer, one-time KYC registration is mandatory to invest in mutual funds. You can complete the same by submitting the requisite documents at any of our branches or collection centers. You may also avail our online KYC registration facility while opening an online account with us. For more details, please visit our website, www.franklintempletonindia.com. Furthermore, investors must invest only with SEBI-registered mutual funds. Details available on the SEBI website www.sebi.gov.in. And finally, investors can reach us on our toll-free helpline 1800-425-4255 or write to us at grievance-redressal@franklintempleton.com for redressal of investor complaints. For escalation, write to us at Head of Customer Service at franklintempleton.com or President at franklintempleton.com, or lodge your grievance with SEBI through their SCORES, SEBI Complaint Redress System, portal at https://scores.gov.in. Thanks for tuning in, and go build that legacy.